All right, what up, traders? It is Jeremy coming at you for the market bias update report on Sunday, the 21st of April. Futures have just opened about an hour and 20 minutes ago. Been sitting here looking over some charts and checking it out, seeing what I think is going to be going on for the week ahead, and I'm here to share it with you. So first off, at the beginning of last week on Sunday, we were sitting right here in the market, and I was saying that until this support level broke, we didn't know if this was the start of more bearish action to come or if we were just going to be in a neutral consolidation pattern. Needless to say, that support level did break on the S&P 500 and the NASDAQ as well, and the Dow Jones as well. So anyways, all three of those indexes have officially broken their neutral consolidation. They have officially ended this bull run. And we can see that in a few different contexts. So for those that are still learning the markets, there are a few different ways to determine bullish runs versus bearish trends versus neutral trends. So I'm just going to run through a couple of those really quick for anyone that's new. First off is diagonal support and resistance. So when you are in an uptrend, you are setting higher pivot highs and higher pivot lows, higher pivot highs, higher pivot low, higher pivot high, higher pivot low, and so on. That is the technical definition of an uptrend when you have a series of higher highs and higher lows. You stair step up as you go. So the first warning shot came right here on this big red candle on the 4th of April. This is when we saw the markets break that diagonal trend line, and they broke it with momentum to the downside. You'll notice if I zoom in here that on that candle, there's basically no lower wick. That means that the price is closed basically at the low of the day, pushing right into the closing bell with momentum. So that is not a great look for the bears, just right off the bat. Next up, when you transition out of a bullish uptrend, you usually don't go straight to a bearish trend. You usually have some form of neutral analysis where the market is trying to figure out what is going on and trying to decide which way it actually wants to go. So we identified the support here from these lower pivots back on, let me move my recording stuff so I can see the date. Back on 315, the low from 315 was really kind of the top end of that support zone. And for those that aren't super familiar with support and resistance, you are not identifying a specific number, you are identifying a zone. Support and resistance is usually defined by multiple pivots coming into the same price point. So the pivot here, the low of 51.67 and 75 cents would have probably been the upper range of that zone. And I'm just going to put a little horizontal line there for us to see that. And then the next pivot that kind of came into that same zone was the top of this one right here on 3-4 again. And if we take that out and draw this one over, that kind of gives us our zone anywhere between there. Now, for me, I like to look at multiple types of support and resistance coming into alignment. So to me, the lower end of that zone corresponding with the 50-period moving average was what I was personally looking at. If we break that line right there, then that is officially nullifying the neutral trend that we had built and going into some form of deeper correction. So on 415, that was kind of the break of that and signaling that we were going into a bigger correction, and that happened on Monday. So anyways, where we stand now, what are we looking at? That's probably on everybody's mind, especially for those that have longer term positions and are wondering what to do with them. So first of all, we are overextended now to the downside. It should not be shocking to everybody that we usually do not run this many days in a row to the downside without some sort of reprieve bounce. We are overextended on our RSI, so it makes sense to me that we will likely see some form of buying in the market come in to drive prices back up and probably coming back into the decreasing 9. That is kind of my base case scenario, somewhere around 50.90. If we do get through that, I am expecting resistance to hold. So this previous support level that we were talking about, support and resistance zones tend to flip-flop back and forth. So when they are acting as resistance, like it was right here, prices came up. On the uptrend here, demand is outpacing supply, and so prices are going higher. Then supply and demand equalize. We get a signal candle here. This is an inverted hammer, and then prices come back down. When prices are coming back down, supply now outweighs demand. So this was a resistance zone. When we did break through that and came back and confirmed, now that resistance zone has switched from being a resistance zone overhead to a support level underneath. It came back down. We had some wick tests back into this zone, testing it as support, and then that support broke. Now it makes sense that while we are on the underside, that prices will come back up, likely to test either the overhead resistance acting as this 9 EMA, this moving average right here, and if we have enough momentum coming in, that we could see it come back up to somewhere around 51.50. My base case is that we are going to see downward pressure in the market for a while. I'm not going to say that this is a sell everything moment, but I do think that it makes sense to start tightening up on positions, to start decreasing risk in your portfolio. If you have gains in certain areas of the market that you want to start to scale out of and lock in, it probably makes some sense to start doing that. Personally, I am going to be looking at this as we've run a little bit too hot and heavy here. Things are stabilizing. A lot of this downward move has been on the backs of inflationary data, news, and the market finally realizing and coming to terms with the fact that we are probably not going to get the 7 rate cuts this year that the market was very aggressively pricing in on this whole bullish run. At no point in time did I think we were going to get 7 rate cuts this year. I think that's absolutely ridiculous that the market thought that in the first place and was actually pricing that in. My base case was somewhere between 1 and 3. I am revising that to say 0 to 1. I don't think we are going to get more than 1 rate cut this year. And I have a feeling that if we do get one at all, it's probably going to come right before elections to try to support the incumbents. That tends to happen when you have inflationary pressures and cycles that we are in right now economically on election years. It's not uncommon for the political party that is in power to try to leverage their power and say, hey, no, we've done really good for the economy. Check this out. And try to prop things up a little bit as it's going into election time. So if we do get a rate cut, I'm anticipating that it happens probably the month prior to elections. And that's a big if we get it at all, because I think there's a lot of risk for a double dip inflation now scenario like the 1970s, and that would be really, really bad. I wasn't alive in the 1970s. I know a lot of you probably weren't either. Some of you probably were and remember that. But go look up a YouTube video or two about the inflationary pressures of the 1970s and the double dip in that and what was going on in the economy if you're interested in it. The summation of it is it's not great for equity markets. So where we're going from here, like I said, I think we are probably due for a little bit of bounce. As another little educational piece here, and sorry this video is going to be a bit longer this week than normal because I really want to give some education on this. The other piece that kind of tips me off to that is this long lower wick on the daily chart on Friday. This tells me that even though there was bearish pressure all the way down to below actually quite a bit lower, below, I was going to say below 5,000. That's where it closed. It actually got down to 49.63. So the bears were in solid control all the way down to 49.63. And at the closing bell, people started to buy that dip. And usually when you have a big bearish move like this, it's not actually people buying the dip to go long and establishing bullish positions. This is actually people that had shorted the market and were profiting on the way down. And now they're buying to close those positions going into the weekend to take the risk off the table and lock in profits. So this buying action is not bullish buying action in the market. This is people that had shorted the market now taking profit. And anytime you have a bearish dip, those are the first buyers to come into the market. People that have shorted the market buy, they create the floor. Then you have day traders start to come in and start to nibble here and there on intraday turnarounds. And then you slowly build up from there to people out on a longer time frame, swing traders, position traders, or investors going, okay, I wasn't going to be the first one to dive in, but now that other people have created that floor, now I feel comfortable buying the dip. So for me, I'm not super interested in buying the dip other than potentially day trading back up to the rising or the decreasing 9 EMA. I might day trade this tomorrow depending on what the chart looks like and if we get confirmation to the upside here. But I am looking for one of two scenarios. Either a double bottom here somewhere around 5,000 or coming back up and retesting the larger resistance zone and then rolling over from there. So I'm looking at basically the 50.75 zone and the 51.50 zone. Those are the two zones on the S&P 500 that I am looking for. And if we get bullish action to come in and push up into either of those, I am going to be looking at those as de-risking opportunities to get out of positions that I have profits in and potentially start looking for shorting opportunities in the market. So that is what I am looking for on the S&P 500. Spent a ton of time on that. I'm not going to spend that much time on the rest of these, but that same concept basically applies to all of the major indexes right now that we are seeing. So rapid firing now from that, let's go out to the NASDAQ. NASDAQ, you'll see very similar thing. We are overextended to the downside. Our RSI is overextended to the downside. We've gone multiple days in a row with significant downward pressure. If we drop this into an intraday chart, we can see at least some stabilization here where we had a big wick test down. Bulls brought it back up. We tested that again, broke it temporarily, and bulls brought it back up. So we're trying to put in a floor here at 17,180. We'll see if this zone can hold. But if that zone holds at 17,180, it makes sense to me again, just like the S&P, we might see some pressure coming back up into the decreasing 9 EMA, which is around 17,670. Or if we get some actual bullish moves coming in and day traders start actually playing the upside, we might see it swing back up into around the 18,000 level. In no form of analysis currently am I looking at us reclaiming these levels and being off to the races to the upside again. I think this bullish trend is totally over. And in combination of the in combination of the inflationary pressures that we have currently and that storyline, as well as the conflict between Iran and Israel and the ramifications for that and potentially increasing oil prices due to instability in the Middle East, and the trickle-down effect that that has on inflation and the cost of basically every good that people purchase, this is not a good situation. So I'm looking for some kind of a bounce in the NASDAQ, in the S&P to de-risk my portfolio, and then going to sit sideline for a little bit and wait to see where the market goes from there. Similar story if we go out to the Russell. The Russell had a little bit larger sell-off. We are still overextended on it, but it is actually down sitting on its 200 period moving average on the daily chart. Let's bump this out to a weekly chart and see what's going on. So we had this resistance zone for the better part of 2 years. We tried to break it, failed, did break it, and all of our moving averages were stacked in a bullish fashion, except for the 50 still being below the 200. We would like to see that be above the 200 for a true bullish run. And if I put this out to a slightly larger time frame, you can see here where we have the green, blue, red, and gray all stacked. So the shortest time frame moving average is on top. That's the 9. Then we have the 20, 50, and 200. That signifies true bullish momentum. When one of them is still stacked differently, where we have the 9 above the 20 and above the 200, but the 50 is still lower, that still throws caution into your analysis. And right now, we are seeing that caution play out. I have no interest in the Russell 2000 right now. And finally, just to go out to the Dow Jones for our major indexes, we are seeing similar pressures in the Dow Jones. We have broken our support level, bam. And right now, probably looking to come back up and test that. And my guess is probably a rollover and moving lower from here. So not interested in this chart either. If we go out to crude light, on the weekly chart, crude light actually looks decent right now. We don't love the big volatility coming in on the Iran and Israel news, but we are sitting on the rising 9-period moving average on the weekly chart and trying to hold that as support right now. If we drop this into a daily chart, it gets quite a bit messier. We did break one of our diagonal support lines, and we are now underneath it. And you can see this huge volatility wick on Friday last week, signaling the market just doesn't know which direction to go with this right now. With pressures in the Middle East, that should push oil prices higher. But we also have a lot of other things playing into this, and the market just was not in any mood to hold those prices and drove right back down. So I'm looking for support to build here on this rising 50-period moving average that corresponds to the rising 9 on the weekly. If we can get some sideways action here for the next few days, if things tend to escalate in the Middle East, we probably will see another spike higher. So I'll be watching for some kind of a day trade and or swing trade in this area. If we go out to Bitcoin, Bitcoin has regained a little bit of ground here. But it had a terrible last week and a half. We ended up having this symmetrical triangle pattern that had been forming for a while and ended up having a wick test higher, broke above it, signaling the bulls should have been in charge, failed, came right back down into it, ended up testing the lower end of that, and then broke it. And then actually had a very volatile Friday and broke all the way back down to do a double test of just under 60,000. Right now, there is not a good statistical or probability read on Bitcoin. It is messy now. I would not be surprised to see us come back up and retest the 20-period moving average. I would equally not be surprised to see this break the 50 and roll back over and test 60K or below again. If we do break below 60K, our next support would basically be down to the rising 20-period moving average around 55,000. So that would not be a particularly good look. And we have a lot of increasing volatility here at the top end of the chart. So be careful with Bitcoin for the time being. Wait for this to play out. Yeah, just sit sideline. If you are in a long-term holding position on it, probably hold, because I am still very bullish on Bitcoin long-term. But on the short term, I think we can expect some more volatility. If we go out to gold, gold has just continued its momentous tear. This is probably one of the largest runs in gold that we have had. I mean, this run was 13% in 21 days. And if we go from the previous, that is up over 20% in gold over 45 days. And I'm just going to throw this out to a monthly chart and see if that is, yeah, so this run was 32% in 122 days. So we went 20% in 60 days and 45 days, basically. So anyways, big run. Out of the last 10 years, we've only had one other time in the last 10 years that we've had this kind of push in gold. And my analysis is that gold is sniffing out some stuff that the market probably has not come to terms with in terms of inflation being a little bit more sticky, and the potential for a double dip inflation. So I see any pullbacks in gold and also any pullbacks of significance in silver to be potential buying opportunities. If silver comes back down and retests anywhere in the 27 to 27.30 range, I'm going to anticipate that that is going to be a significant buying opportunity, so I'm keeping an eye on that. Finally, let's go out and check out our UUP for the US dollar. This is also not helping our equities positions and the major indexes and stocks in general. We had been saying for the last several weeks, I'd been saying that we did not want to see this 50-period moving average get violated. And last week, it not only got violated, but it got violated in dramatic fashion. That is one of the biggest, most bullish candles that we've had in a long time, and definitely this year. The last big candle like that that I see is this one right here from back in May of, what is that, 2023, so over a year ago. Anyways, yeah, so big bullish candle. This is putting pressures on equities, and I'm expecting that if this level here breaks at 29, that that's not going to be great for the market. We're probably going to see it drive up to the 29.50 zone, and that's going to continuously push pressure on the major indexes and the stock market in general down, in addition to anything going on in the Middle East and in addition to inflation. So not a good catalyst here. Finally, let's wrap up, go out to our economic data coming out this week. Tuesday, we have PMI data coming out, so that'll be important for inflationary conversations. We have advanced GDP, unemployment claims, and pending home sales on Thursday. I'll be interested to see what the pending home sales is on that. Unemployment claims has been fairly steady all year, so I'm not anticipating that to move the market. The pending home sales might. Core PCE price index is going to be really important on Friday, and then consumer sentiment. I am assuming that this is going to take a fairly significant drop because this last week, obviously, consumers and market participants have soured significantly. So I'm expecting this to drop and come in quite a bit lower than forecasted. Finally, if we go out to our heat map, get rid of the ad. There we go. This is showing 1 week of data, and you can see all of the red scattered all over the place. And anything that is green is basically just buying off the lows from big bearish runs, and most likely, again, closing out of bearish trades. It's not really people being actually bullish on those sectors. So you can see big tech, all of the areas of the market that had been leading the charge over the last 6 to 8 months are now getting taken out behind the woodshed and just slaughtered. So I am anticipating that to continue, honestly. Any bounces in these areas of the market, I am anticipating people are going to be de-risking on. That is currently my game plan, as I said. So anyways, if you have long-term positions in these areas of the market, be careful with them. If you do want to hold them long-term, so like years, you're probably fine just sitting on them, because obviously when we do bottom out and we do get through all of this nonsense, these are going to be the areas of the market that lead the market higher once again. They usually are. But in the short term, because they have pushed so hard and so fast over the last 6 to 8 months, they have a lot of room to the downside to potentially drop. So just be careful on those, and potentially think about buying some put options or scaling out of positions a little bit if you have positions in those areas. So hope that helps, guys. I know this was a little bit longer, but just wanted to do a little bit more in-depth education this week, because we are getting into some fairly significant volatility in the market, much more than we have seen over the last 6 months. Trade safe. As always, let me know if you have any questions. Hit me up in the comments, and I will get back to you as soon as I can.